Hello traders. It is proven that majority of traders are failing at trading because of wrong expectations. Most new traders come into the markets with a dream of making so much money. They focus on the return that the market can offer, neglecting on the risk that are in the markets. I feel like once you come into trading, your main focus should be on the risk and not the reward. You see, the main goal of any trader in the market is to preserve what they have first, meaning you must preserve your capital. And the moment that you know how to keep your downside safe, your upside will always take care of itself. But before we continue on the psychological part of trading Forex, let us first look at the technicals that guided us to take the trade that you can see on your screen. I have a buy trade running. My reasons for entry into this trade is actually very simple. This is happening on the 30th of October 2025. The market is bullish, meaning that we are having a bullish bias in the market, meaning that I will only be looking for buying positions. Secondly, I trade based on key liquidity levels and the basic supply and demand. What I want to see in the market before I take a trade, I want to see a bullish confirmation order block at a key buy side liquidity level, and then I can take my buying position. My risk to reward ratio is 1 to 2. I risk 1 to get 2. You will notice that in the markets, I have different types of levels. As I said earlier, I trade based on key liquidity levels. To establish my market bias, I calculate these key liquidity levels and my central pivot points. As per now, it is that black horizontal line that you can see, which is priced at 39.3957.31, which is 3957.31. That is my central pivot price. Meaning, if I was to use it for market buyers, that will mean that any price that will trade above that level, the market buyers will be bullish. And if the price will be trading below that level, that will mean that the market is bearish. Other levels are the buy side liquidity levels. These are the levels that are above 3957.31. They are represented by the blue horizontal lines. The other levels are the sell side liquidity levels. These are the levels that are the red horizontal lines. These key levels are below the 3957.31 line. They represent selling opportunities. These levels, the buy side liquidity levels, are 7 in number, while the sell side liquidity levels are also 7 in numbers. In this case, our first buy side liquidity level was at 3986.11. That is the first blue line from the central pivot points, while the second buy side liquidity level was at 4004.07, while our third buy side liquidity level was at 4018.54. When we come to the fourth buy side liquidity level, it was at 4032.97, while the fifth buy side liquidity level is at 4053.56, while the sixth buy side liquidity level is at 4079.76 level. The seventh buy side liquidity level is at 4155.43. What are the importances of these buy side liquidity, key liquidity levels? These levels will add confluence to our basic demand and supply. We want to see a confirmation order block at a key buy side liquidity level before we can take our buy positions. Remember that in the market, you will come across different type of buy orders, bullish order blocks, but really the high probability bullish order blocks will appear at only these key liquidity levels. This is where I will be taking my buys. Secondly, these key liquidity levels are levels that will clearly inform me where to place my stop losses and where to place my take profits. That is the importance of these key liquidity levels. They are the high probability areas where institutional forex traders are watching either to take their entries, to take their profits, or to place their stop losses. When it comes to the sell side liquidity levels, our first level is at 3928.51. Our second liquidity level is at 3910.55. And our third liquidity level is at 3896.09. That is the price. And our fourth liquidity level is at the price of 3881.65, while our fifth sell side liquidity level is at the price of 3861.06. Consequently, our sixth level will be at the price of 3834.86. Our last sell side liquidity level will be at the price of 3759.19. These levels are so important when trading. They will improve your probability of your trades hitting your take profits and therefore increasing your P and L ratios. So the reasons for entry into the market that you're just seeing is that I just putted a confirmation, a bullish confirmation order block at a key liquidity level, which was the central pivot point at 3957.31, and I entered into that market. My stop loss is at 3943, while my take profit is at 4004. My stop loss is a 30 minutes ATR, while my take profit is 2 times the 30 minutes ATR, or you can use the 4-hour ATR levels for your take profits. So after we have having done the technical side, Let us go back on the psychological part of trading forex and see how expectations can really affect our trading. When I take a buy position like this, there are only four expectations that I have in the market. That my position can either go to my take profits, or that position can go to my stop loss, or I can break even in that trade, or I can have a result of a cut loss. A take profit is a situation whereby my trade has successfully achieved a 1 to 2 risk to reward ratio. So my take profit is my reward. My stop loss is a situation whereby my trade has gone to the one risk that I had put in the market, and that is my accepted risk. My break even is a result of a situation whereby the market had moved 1 hour into my position and I moved my stop loss to my entry. If that trade will come back to my entry and take me out, that will be a break even trade. What is a cut loss? You will hear most professional traders tell you that cutting loss is an edge in the markets. So, cutting loss means that when I lose the same reason that got me into the market, I am immediately getting out of that market with a small loss. That is what is called a cut loss, meaning that I am not willing to wait for that market to go and liquidate my stop loss. No, I have I have a key liquidity level in the markets that when the price will go beyond that key liquidity level, I am willing to get out of that trade with a small loss. Remember, in these markets, you either understand how to trade liquidity or be the liquidity in the market. So, at all cost, I am not willing to accept to be the liquidity of other traders. What is liquidity? In simple forex term, liquidity are a cluster of stop losses in the market. After enough experience in the market, and after trading for some years, I know where majority of traders have placed their stop losses. So when I see the price going to that area, the key liquidity area, I know that it is going for that liquidity. I am willing to go out of the market as fast as possible without hesitation, without any doubt, and I am taking a small loss of the table. As you can see on the chart, at the price of 39.57, which was my central pivot point price, if the price will go beyond that line, if I get a 1 minute candle close below that line, I am taking the small loss. I am not willing to see the market go to my stop loss, which is at 39.43. No, I'm cutting my stop, my I'm cutting my losses at that price without hesitation. As fast as possible, I accept that loss, I move forward. I know that I have an opportunity to get into the market again and practice my edge again. So cutting losses are going to preserve your capital. They will make sure that your account credits is enough for you to trade again tomorrow. So as you can see, I am in a small drawdown of $2. This does not worry me because the market is consolidating around that key level, and the price is currently at that price. But the moment that price will close below 39.57, I am closing that trade and wait to see another opportunity. We said if I lose the same reason that took me into the market, I am getting out as fast as possible. You can see right now it is in a small loss of $7, $8, but it has not yet closed below the level of 39.57. So that trade is active. You can see how the price is respecting that level. It has established a wick. You can see it has bounced off that level of 39.57 for some time, and that shows that it is a key liquidity level. Let us go now to the psychological parts of trading, where we were discussing about expectations and how expectations are making you lose in the financial markets. You see, when trading forex, realistic expectations center on consistent, modest profits rather than getting rich quickly. You see, in the markets, success is a long term endeavor requiring discipline, emotional control, and robust risk management to navigate a very highly volatile markets. Professional and successful traders often aim for moderate, consistent monthly return. Let's say a monthly return of between 1 to 10% is very, very realistic and not astronomical gains. Chasing unrealistic large profits can lead to reckless behavior and significant losses. While monthly percentages may seem small, compounding these gains over time can lead to significant account growth. Focusing on steady progress is a more sustainable strategy than pursuing a get rich quick fantasy. You see, even the most experienced traders cannot guarantee profits every month. You see, losses are a normal and inevitable part of trading, and a realistic mindset accepts this as part of the business. The amount of profits you can realistically expect depends on your capital. Trading a very small account often leads to taking oversized risk to see meaningful returns, while increases the likelihood of you blowing the account. Okay? So the most important rule in trading is to survive first and then profits later. So your primary expectation should be to protect your trading capital, not to maximize every single trade. So a common strategy is to risk only 1 to 3% of your total accounts on any single trade. This ensures that a series of losses will not wipe out your accounts. And it is a good practice to always use stop losses. Expect that you will be wrong sometimes and use stop loss orders on every single trade. This is a critical tool to automate your exit from a losing position and prevent emotional trading. Okay? Equally, it is very important to manage leverage carefully. While leverage can amplify profits, it can also magnify your losses. Expecting Expect to face powerful emotions like fear, greed, and overconfidence, and focus on managing them. Emotional control is key while trading the financial markets. These feelings, if unchecked, they will disrupt your discipline and they can lead to impulsive, irrational trading decisions. But always remember that patience is a virtue. Impatience can lead to over trading. It can lead to forcing trades that do not meet your criteria. Successful trading involves waiting for the right setups rather than constantly being in the markets trading anything and everything that you see. Remember that trading the financial markets is a continuous learning process. So your expectations should be to embrace this continuous learning process. The market is constantly evolving. So expect to be a student for your entire trading career. Trading this market successfully requires ongoing education to adapt to new conditions and refine your strategy. Consequently, learn how to accept losses is a learning experience. A losing trade is not a personal failure. It is an opportunity to learn. Keeping a trading journal to review your decisions will help your strategy and mindsets. How do we practically improve our expectations in the markets? First, as a trader, you should be in a position to develop a detailed trading plan. What is a trading plan? Like what a constitution is to a country, that is exactly what a trading plan is for a trader. Expect that successful trading is a business, it is not a hobby. You should have a detailed plan outlining your strategies, risk rules, and goals. And you must be disciplined enough to follow it. If you lack enough confidence to trade a live account, for you to build your confidence and manage your expectation, it is wise to trade in a demo account. Before risking real money, expect to spend significant time practicing on a demo account or paper trading. This will help you to build confidence and master your strategy in a risk free environment. The amount of time you can dedicate to research and analysis will directly impact your returns and expects to invest serious efforts in understanding the market fundamentals, technical indicators, and some economic events in your journey to profitability. Many people are intrigued by the idea of making millions while working from home or any place that they want. Although trading offers these opportunities, the majority of new traders have to realize that reaching this ambitious goal will probably take much longer and require more efforts than initially planned. Traders must also have realistic expectations about their potential returns and understand that every unit of profit is accompanied by a unit of risk. If you are just getting into the forex trading market, you know how difficult it can be to set goals based on all the different factors working with you or working against you. The harsh reality of forex trading is that most forex traders lose money. However, if you do your research or go into it with a clear head, with adequate knowledge, with a plan, there is no limit to how much you can make. When you are making your strategy for your forex trading career, however, it is helpful to have realistic goals in mind. This way, it is easier to identify when something is not working. You see, for long term success, it is important to set expectations to better manage all trading activities as well as emotional well being. When pursuing forex trading, expectations can go from high to low. Depending on a trader's resources and expertise, reaching a profitable level of forex trade can either be quick or extremely gradual. But the most important thing is to remember that expectations must be realistic. This is based on the time spent mastering the skill and optimizing performance in forex trading. One of the reasons why some traders fail to achieve their goals is the lack of concrete follow through. It is not enough to set a particular weekly profit targets. Think happy thoughts and expect it to magically becomes a reality. No. Keep in mind that goals must be accompanied by specific steps to attain it. And these steps must be realistic and they must be action oriented. To facilitate this, one must also figure out which type of goals to aim for. For beginner traders, it would be wise to set out on goals that focus on the process. I repeat, it must be process oriented as opposed to the outcome. These types of goals, they will help you to reinforce and shape your trading skills so that you learn how to trade properly. Unrealistic expectation may lead a trader to commit certain mistakes that those with greater experience and realistic expectations may not commit. Remember, in order to achieve a realistic based outlook, a new trader should conduct research on what successful traders are earning, the capital required for those returns, what strategies are used, and what risk management system is in place for them to get the types of results that they want. There is a substantial risk of loss in forex trading, and always past performance is not always indicative of future results. Dear trader, you probably want to have at least some idea of how much you actually want to make or how much you actually want to lose while trading. If you are thinking of beginning trading currencies through forex trading, you have so many dreams about your career and realistic expectations when you enter the forex market. You know, the forex market is the world's largest investment trade market, and you can make money. Making money is also an expectation. It is a market where a person can make endless profits, but it doesn't mean you can generate those millions of profits overnight. Most literers have unrealistic expectations for the global markets. You have to realize that forex trading is like running a business. At the end of the month, like all the most successful businessmen throughout the world, they evaluate their business books. When it comes to forex markets, you have to build a rational expectation of how much you can possibly make. Instead of looking for a 100% profit in forex from your account size, you can expect a return of between 1 to 10%. Take the time to calculate everything you need because it saves the capital of your trading in the long term. It is a great achievement for you as a retail trader if you can secure a profit of 10% annually. You see, forex trading should not be an expensive way to achieve success. You see, time, practice, and commitments are needed to achieve this. You can have a successful career in the financial trading markets if you monitor trading activities, if you maintain your strategies, and practice your business to improve your skills. Knowing how the forex market fluctuates is vital to your success in your trading career. Overestimating profits can result to break and can give you your potentially lucrative forex career early on, and underestimate your strategy by missing potentially fatal mistakes. You see, many traders believe that a combination of good management of capital and a good strategy can lead to high returns. However, most forex traders can also lose heavily because they do not have sufficient initial capital to achieve a possible next win. The average monthly return for forex traders is between 10% per month. Remember, if you make an insufficient effort to learn how to use different kind of analysis and high quality tools used by professional traders, you will not get close to the 10% that we are talking about. Apart from the four expectations we had earlier talked about, the take profit, the stop loss, the cut loss, and the break even positions. As a trader, you cannot have any other expectations in the market whatsoever. And a lot of people, when they start trading, they go into the markets with these expectations. That I can predict the markets and that they can do it and that they can prove to themselves that they can be a trader. And when you are expecting the market to do what you want it to do, and when you really need to prove yourself that you can do it, at that time you are entering into the market with emotions. You are not looking at the charts logically. No. You're not analyzing or letting the market tell you what it wants to do. And when you are expecting it to do things, you have no control over the market whatsoever. You cannot expect it to do anything that you want it to do. And when you have these expectations, that's when you start to make majority of your trading mistakes. For example, if price is coming down to your supports zone or a demand zone or an order block and you are expecting it to bounce, but in reality it is showing you that the structure has changed. It is now in a downtrend instead of an uptrend, and you're just going to buy at that support level because you expect it to bounce instead of waiting for a reaction or whatever it might be, and your expectations are in it going that it is going to go up. And when it doesn't go your way, then you take it as a personal attack because it didn't fulfill your expectations and it hurt your ego because you were wrong. As a human, we do not want to lose. We always want to be right. And trading is the one field that does not care about that. And you have to completely rewire your brain when you become a trader. And so, when the trade goes against you and it hurts your ego and it hasn't fulfilled your expectation, then the other things kick in. The other things like revenge trading. So, as soon as your ego is bruised and you feel a bit of pain, it is because you have lost the trade. What happens is that you start to revenge trade because you need to prove that you are right and you need to win that money back because it wasn't fair, because the market didn't do what you wanted them to do. The markets were supposed to go up. I expected them to go up. So now I want my money back. That is revenge trading. And then you just end up giving more money away, and it all stems from your expectations because every single time that the market moves, there are different traders, different leverages, different margins, and every move is unique. No two moves in the markets are the same. And that is why when the market move, it does not move like all those graphs and cherry pick charts where they say that this is a perfect whatever that they want to say it might be. That's why the markets never look like that. It is because it is made up of different types of traders at different single times. And it is never going to be symmetrical. No, it is never going to be perfect because this is real life. And just because something done it before, it doesn't mean the market is going to do them again. And when you are expecting things to happen, especially in trading, it's all emotion. You're just trading with pure emotions rather than logic. Because, for example, you could be looking at a chart and you've got a bias that the price is in an uptrend. And given so, yes, it is in an uptrend and it is making higher highs and higher lows. But because you're so fixated on it being an uptrend, and then the price breaks and now it is in a downtrend, but you do not want to accept that it has changed because you are hell bent on your bias that it is in a uptrend. So instead of listening to what the market is telling you and reading structure logically, you are now fighting against the market because you expect it to be in an uptrend. Because that is the bias that you have decided for yourself. And this is when you start to make trading mistakes. So now you are longing and you are going against the markets. And when you go against the markets, usually it is going to cause you a lot of pain because you are fighting the majority of the market who are trying to sell. In that case, when you are trying to buy, you might push the price down and you're trying to push it up by yourself. And then when you think that the market is out to get you because you expected it to do this and it hasn't done that, and it is a personal attack, and the market's out to get you, you start asking yourself some questions. Why can't I trade? Why can't I do this? And then you just flow over into all these emotions because your expectations as a trader haven't been met. And there are other things, for example, your stop loss. You expect the price to go up, so you start pulling your stop losses lower and lower and lower because you expect it is going to bounce and that it is going to back up because you are hopeful, because you are biased, and you are holding on to the expectation that it is going to bounce rather than saying it is okay. My trade has been invalidated. I need to get out now to minimize losses. Otherwise, the losses are going to keep getting bigger and bigger and bigger. But instead, you expect it to bounce. So you pull the stop losses down further and further and further, and now you are way too much in drawdown, and then you blow your accounts because you expect the market to do what you want it to do, but the market is going to do whatever it wants. It is not that it doesn't care what you want it to do. There is so many different type of traders, so many different people, so many institutions, all that stuff that are active in the market. They do not care what you want, just like you do not care what they want, because you want what you want to happen in the market, and the expectations are what are causing you so much pain. And the moment that you stop expecting that the market to do what you want them to do, you feel as a trader, because the market doesn't owe you anything. It doesn't owe me anything. It doesn't care. It doesn't owe anyone anything. And I went through this as well. Like, I've been through everything you could possibly imagine as a trader. Like the ups and the downs, the struggles, everything. And I used to be the same. I used to be blinded by the charts because I'll be so zoomed in on what I wanted to see. And I was like, nope, it is an uptrend. It is an uptrend, and I will keep longing, and the market could keep reaping against me every single time. And I would be, you know, pulling my hair out, thinking, why is the market going against me all the time? It was supposed to bounce. It was supposed to do this. It was supposed to do that. It's not supposed to do anything. It's going to do whatever it wants. And I just couldn't get over the fact that because I just had to be right, I couldn't be any wrong. And I was so scared to be wrong. And I've talked about analysis paralysis before. And because of these pains, it is flowed over, and I had analysis paralysis because I couldn't stomach being wrong because my ego wanted me to be right. And all the time, I just had so many expectations on trading because online you see all this stuff and they're always saying my predictions. I predict the markets, and predicting the market is another form of an expectation because you expect it to go up because that's what you have predicted. And trading online is framed in this way that people can predict the markets and they can predict the future, and they know where it is going up, and they have now, and I have mentioned it before. If you go online, you may think like everybody is a fortune teller, that they can tell where the price is going and that they have control over it. But truth be said, they don't. And so when you are looking at this stuff online all the time, you may start to think that, oh, well, I can predict the future. I expect the price to go here because my strategy says so. And then, when you tie the outcome of the trade to your self worth and say, oh, well, I was wrong, I didn't get it. How come they can predict the markets, but I can't? This isn't fair. But realistically, even them, they can't predict the markets. And if you look deep enough, they've probably posted about a short position and a long position. And whatever, whenever one plays out, they share and go, saying, I was right, exactly as I predicted. But remember, a broken clock is right twice a day. So, realistically, like, just let the expectations go. Stop expecting the market to do what you want it to do. Just be patient, wait for the market to come to you. Stop front running trades because you expect them to bounce. Wait for a reaction. Wait for the market to show you a reaction. Wait for it to show you that it's going to end. You know, if it potentially reverses there and stops there, or whatever it might want to do, stop expecting it to do things. Stop pulling the stop loss orders down because you expect the market to go up, because that is your bias and you think it's going to go here because you have decided and it is going to go here. You need to be very, very flexible when it comes to trading. Like, you just go in with an open mind. Just go in. Don't expect don't expect anything. You have no expectations. Don't expect to win. Don't expect to lose. Nothing. Look at the market from a neutral positions. There shouldn't be any positive or any negative. You know, thoughts or feelings towards trading should be neutral. The price just goes up and down. That's it. It doesn't do, or maybe it goes a bit sideways, but like most of the time, price just goes up and down. That's it. And the moment you stop expecting it to go a certain way and realize that you have no control over the market or whether it goes or what it does, the more calm you will feel as a trader inside. The less angry you'll feel when you hit your stop loss, and you'll feel a lot more calmer, and you won't feel like revenge trading because your ego has been hurt. And you need to prove yourself right. And you need to prove to yourself that you can do it. If you can follow a strategy on repeats and do not break your rules and consistently do that, that is proving that you can trade. Everybody attaches the outcome of their trades to whether they can trade or not. But if you can follow a strategy and not break your rules, you can trade because the outcome is irrelevant. Because you can expect a winning trade and you can't expect a losing trade. All you can expect from trading is waiting for your setup and entering, and that is it. And letting the rest play out. It is what it is. Whatever happens on the other side, but just stop expecting the market to do what you want it to do. Just be there, ready to listen to what it has to tell you. When it comes to your zone, this is where your system says to buy. Okay, great. If it ends up in a loss, so what? If it ends up being a winner, so what? Did you follow your system? Yes. Okay, that's very great. And that's all you need to focus on. Have no expectations in the market. Don't expect 4 or 5 trades in a month. Don't expect 5 trades a day. The market will give you whatever it wants to give to you. Set alerts, walk away. Have a calm mind. If you feel like you are having expectation towards the charts, don't trade that day. If you feel like a move or you expect a trade, so then you start forcing something, don't trade that day. Just walk away. Do some meditations, do some journaling, read a book, stay away from the charts. Learn to go in there with a clear, open mind and let the chart tell you what it wants to rather than trying to force your narrative on the charts. You see, every trader enters the market with a dream, the dream of catching the perfect move, the dream of doubling the account, and finally proving that all the efforts, the sleepless nights were worth it. But somewhere between clicking the buy and watching that red candle appear, something subtle and dangerous happen. Expectations take over. At first, it feels harmless. You set your entry, you define your stop loss, you mark your targets and wait. But as the trade moves, so do your emotions. You start hoping, you hope that it goes up faster. You hope that it doesn't hit your stop loss. You hope that the market just comes back one more time. And that hope, that tiny emotional whisper, quietly overrides everything you thought you knew about discipline. Hope makes traders freeze when they should cut losses. It makes them greedy when they should take profits. It blinds them to reality and keeps them tied to trades that are already bleeding out. It's not the red candle that destroys traders. It's the belief that the next one must be green. To understand this, you have to see what hope really is in trading. Hope isn't optimism. Hope is emotional resistance to reality. It's your mind refusing to accept what the chart is clearly showing you. The losing trade becomes a potential comeback. The clear trend reversal becomes a temporary pullback. The rules you swore to follow become optional, just these ones. And this is where traders lose everything. Not because the market tricked them, no, but because they refused to see what was already true. Imagine this: you enter a trade based on your strategy, everything lines up perfectly: the setup, the timing, the confirmation. Then the market moves against you. You tell yourself it is just a retracement. It dips further. You hold on. You start justifying it's still within market structure. It will reverse soon. Then the candles keep falling. Your reasoning collapses into pure emotions. It has to turn. It just has to. But the market doesn't have to do anything. It never owed you a reversal. It never cared about your analysis. It never cared about your entries or your emotions. The market rewards probability and not hope. Hope is a survival emotion. It is what keeps humans fighting when everything looks lost. But in trading, the exact same instinct becomes your downfall because the market don't respond to emotion, they respond to logic, they respond to numbers and behavior patterns. Think about it. If you were a soldier trapped in battle, hope might keep you alive. But if you are a trader trapped in a losing position, hope kills your capital slowly. As a professional trader, I understand this difference. We have trained ourselves to replace hope with acceptance. When the trade hits our stop loss, we do not pray, we exit. When the setup is invalidated, we do not argue with the charts, we move on. That is not emotionless trading, it is mature trading. Because maturity in trading is realizing that your job is not to predict the market, it is to respond to it. You can't control what happens next. You can only control what you do next. Expectations in disguise also builds pressure. Before you even enter the trade, you already have decided how it would go. You've imagined the profits, the excitement, maybe even the screenshot you'll share with friends, but that mental image becomes your emotional prison. When the trade starts to move differently, it doesn't just threaten your money. It threatens your expectations of how it was supposed to happen. And when that expectations break, so does your discipline. This is why many traders keep losing even when they have a great strategy because they enter every trade not with execution in mind but with outcome in mind. They measure their success by how much they made, not how much or how well they followed their process. The irony is the moment you let go of hope, when you truly stop expecting anything from a trade, that's when you start trading well because your focus shifts from wanting the market to do something to reading what it is actually doing. Let's look at an example. A trader named Daniel had a system that worked: clean setups, solid risk management, risk to reward ratio of 1 to 2. But every time he took a losing streak, he'll start tweaking his system, adding indicators, jumping from one method to another. He wasn't reacting to his data. He wasn't reacting to hope. He hoped that if he changed something, he'll find a perfect strategy that never loses. But the truth is, every strategy loses. Every professional trader takes losses. The only difference is professionals don't expect perfection, they expect probability. Before we dive deeper, let me ask you this. Are you struggling with fear, doubt, or overtrading? The truth is that most traders don't fail because of bad strategies. They fail because of bad psychology. That is why you need to master your mind. You need to master your trades. But real mastery comes from accepting pain as part of the process. That is what most traders never understand. Losses are not punishments, they are feedback. They tell you whether your decision was correct based on your rules, not based on your results. If your analysis was solid and your risk was managed, it is a good trade, even if it was lost. If you broke your rules and got lucky, it's a bad trade, even if you won. This mindset, this mindset shift destroys the power of hope because when you stop measuring success by results, you stop needing the market to move your way. You start thinking in terms of process, not prediction. And that is where calmness returns. The professional trader knows they can't predict what candle comes next, but they can predict how they'll behave when it comes. That is power. That is confidence. So the next time you find yourself staring at a red position, whispering, please come back, stop and ask, what am I really doing right now? Am I trading or am I hoping? Because if you are hoping, you are no longer in control. The market is. And until you learn to separate your expectations from the execution, the market will keep teaching you the same painful lesson. Hope has no place in trading. It feels like faith, but it's really fear wearing a mask you do not need. You need clarity, you need discipline, and the courage to face the reality exactly as it is, not as you wish it to be. Once you understand that, your mindset changes completely. You stop asking, will this trade win? And you start asking, did I trade it right? Because in the end, trading isn't about guessing what happens next. It's about mastering yourself while it happens. And that is the moment that hope dies. and consistency begins. Hope doesn't just appear when you lose a trade, it sneaks much earlier, quietly, and invisibly during your analysis, your setups, and even the way you talk to yourself about trading. It disguises itself as confidence, as faith, or trusting in the process, but deep down it is not. It's attachment to specific outcome. Every trader knows that the market does not owe them anything. Yet most traders act as if it does. If you take an emotional pull, this inner voice that whisper, this one must work, that is the first sign that hope has replaced logic. You are no longer thinking objectively. You are emotionally invested. You are already creating a fantasy in your head. What the chart should do, and how much you'll make, and how this trade will fix your week. And once that fantasy is formed, your brain starts rejecting any information that threatens it. That is how traders become blind to danger. Okay? When the market starts showing signs of reversal, the emotional trader does not see red flags. They see temporary retracements when volume drops or momentum fades. They call it just a pause. And when their stop losses get close, they start moving it further and further away because they cannot emotionally handle being wrong. This is the psychology of self delusion. Hope is powerful because it feeds the part of the brain that wants to avoid pain. It gives you a reason to believe that if you hold on little longer, things will turn out. But in trading, that little wrong longer often turns small losses into disasters. The truth is, hope is not your friend. Hope is your anesthetic. It numbs the pain of facing the reality until it is too late to understand how deep this runs. You need to know what happens in your brain when you trade with expectations. The moment you release or place a trade, your brain releases a chemical we call dopamine. The same chemical that fuels gambling, social media addiction, and excitement. It creates anticipation. You start visualizing the outcome. You see the profit. You imagine the feeling. That rush of dopamine connects to the reward system in your brain. And that when hope is born. Now, as the market moves, your brain reacts to every tick like it's life or death. When the trade goes in your favor, dopamine spikes you to feel powerful. When it goes against, the cortisol, which is the stress hormone, floods your system and you begin to crave the high again. You don't want to close the trade because that means accepting loss, which is painful. So you hold on, you wait, you hope. You are not trading anymore. You are emotional gambling. Most traders don't fail because they lack technical skills. No, they fail because they do not understand how emotions hijack their brain chemistry. The longer you stay in a hopeful state, the less rational your decisions become. You stop following your trading plan and you start following your feelings. And feelings are terrible traders. Let's look at a story that happens in the trading rooms every single trade. Let's say trader X enters a buy position on gold. He has a clear plan, a clear entry, a stop loss, a take profit. The setup aligns with his rules, but after entry, the price drops slightly. Instead of sticking to the plan, Alex feels anxiety. He starts zooming into smaller time frames, convincing himself it is just a pullback. The market drops further, hits his stop l- loss, but instead of closing, he drags it lower. At this point, Trader X isn't managing risk, he is protecting his ego. He's hoping to avoid being wrong. Hours later, the market continues to fall. His $50 loss turns to $300 loss. The pain becomes unbearable. Finally, he closes the trade entry when angry and frustrated. A few minutes later, the market rebounds. He screams at the screen, blames the market for manipulation. But what really happened? Hope tricked him. He didn't lose to the market, he lost to his inability to accept loss. That is what most traders do. Hope doesn't make you patient, it makes you blind. True patience is built on trust in your process, not attachment to an outcome. If you followed your plan and lost, that is not failure, that is feedback. But if you broke your rules and got lucky, that is not success. That is self sabotage disguised as a win. Now, here's where it gets deeper. Hope doesn't only appear in losing trades, it appears in winning trades too. When you are in profit, hope makes you greedy. You start hoping from markets keep running. You stop trailing your stop losses. You ignore signs of exhaustion. Then, when the price reversal and eats your profits, you panic, you close too late, you feel regret. The same emotions that made you hold on to losses also makes you hold on to winners for too long. So how do professionals handle this? How do they kill hope before it ruins their decisions? The answer is brutally honest. The professionals don't just manage trades, they manage the expectations. Before they click buy or sell, they have already accepted the possibility of a loss. They've detached emotionally from the outcome. Their mindset isn't this trade must win, but this setup has an edge. I'll take it. If it fails, I'll move on to the next one. That's emotional detachment. This is what will make the professionals consistent because consistency doesn't come from avoiding pain. It comes from accepting it without resistance. You cannot control what happens after you enter a trade, but you can control your emotional reaction to it. The moment you let go of needing to win every single trade, you start trading from clarity, not fear. And clarity is where logic thrives. Let's dig deeper into that word logic. In trading, logic will mean acting on objective data, not subjective feelings. It means letting price action, probability, and structure guide your choices and not your internal dialogue. But when hope takes over, logic is replaced by narratives. You start telling stories. Instead of reading charts, it's consolidating before a breakout. It's just the market maker collecting liquidity. It will bounce. It always does. Those aren't observations, those are emotional justifications. They give you comfort, not accuracy. Here's the irony: traders use hope to escape short term pain, but it only creates long term suffering. Cutting a loss early hurts for a moment. Holding on to it out of hope hurts for days and sometimes weeks. So that's the fix. You must train yourself to accept uncertainty. That's mean going into every trade with zero emotional bias, whether it wins or loses. You are okay because you are not attached to the outcome. You are committed to the process. When the when you expect uncertainty, losses don't shock you. Like we are in a loss of $7. It is not shocking us. They inform you and start viewing them as part of the equation, not as signs of failure. And something magical happens. The less you hope, the more you see clearly. So, we if the loss comes below our key liquidity level, we'll be forced to cut that loss. The professional traders are consistent, and once you make the shift from emotional attachment to a logical acceptance, your entire psychology changes. You no longer panic during drawdowns. You don't celebrate too much during the winning streaks. You just execute calmly and consistently. You stop seeing each trade as a test for your identity and start seeing it as just another data point in a long journey. So the next time you catch yourself saying, I hope these trades work, please stop right there. That's your warning signal. You've already started attaching your emotions to the outcome. Instead, replace that thought with this: trade fits my plan. Whatever happens next, I'll manage it professionally. That's how logic wins over hope. It's not about feeling confident, it's about being prepared. Because in the end, the market doesn't reward those who hope the hardest, it rewards those who adapt the fastest. Hope is an emotional resistance to uncertainty. Logic is a peaceful acceptance of it. And once you master that mindset, you stop needing the market to prove you right. You start to let it teach you what's true. That's when you finally stop chasing what you wish would happen and start trading what is happening. Every trader eventually faces that moment when they realize they can't control the market. They can't control when a candle reverses, when volume dries out, when a sudden news event destroys a perfect setup. But still deep inside they try. They start at chart longer, they stare, they move their stop losses lower, they re-enter too soon or double down on losing trades. It is all because chasing the sense of control that never truly existed. We are in a small drawdown of $7. But remember, anxiety, fear, impatience, revenge, desperation, with all this, you cannot think logically. When you are emotionally hijacked, you stop thinking and trading in probabilities and you start trading beliefs. You start predicting instead of reacting, hoping instead of observing, forcing instead of accepting. But what does it actually mean to let go? Doesn't mean giving up or being careless. It means detaching emotionally from the outcome while still executing your plan with precision. It's about focusing on what you can control: your risk, your entry, your exit, and your discipline. Everything else belongs to the market. Think of it like sailing. A sailor cannot control the wind, but he can adjust the sail. If he fights the wind, he gets nowhere. If he flows with it, he moves forward. That's trading psychology in one sentence. When you let go of your control, something interesting happens. Clarity returns. You begin to see the market for what truly is, and you want not what you want it to be. You notice detail that you ignored before. Structure shifts, momentum changes, liquidity zones. You stop reacting emotionally and you start responding intelligently. That's the mindset you create consistently. Now, let's talk about the deeper layer. That's the greed, the fear, and you want to feel and be in control of the market. Losing a trade feels like losing part of yourself. And when that happens, your brain fights back with denial. You tell yourself, just a pullback, it's a bounce, it's not yet over. I'll give it one more chance. It's just manipulation. I'll hold. These are not just trading decisions, they are emotional defense mechanism. They are your mind's way of protecting your ego from pain. But in trying to avoid short term pain, you create long term distractions. So please pay close attention to that. The best traders in history weren't those who were immune to trading emotions. No, they just learned to face it faster. Like Jesse Livermore, one of the most famous traders of all time, he said that the market is never wrong, but opinions often are. That single line is very powerful. It reveals everything. He learned that the moment he stopped trying to be right, he started to make real money. Because when you no longer need to prove your prediction, you start respecting the truth that the market gives you. And the market always gives the truth if you are calm enough to listen. Here is something most traders never realize: you can't control outcomes, but you can influence probabilities. When you follow your edge repeatedly without emotional interference, probabilities start working in your favor over time. But if you break discipline once because of hope or fear, you reset the cycle. Each broken rule is a signal to your brain that emotions, not logic, are in charge. You have to retain that connection. You have to teach your mind that it is safe and okay to lose. Like right now, the price is starting to go beyond and below our central pivot price, which is at 39.57. And according to my trading plan, if that 1 minute candle closes below that price, it is time to close our trade to cut our losses short. We can see that we are floating on a loss of $12. Our stop loss is quite far away, but if that price closes below that level, we are closing the market. Yes.